You're listening to a podcast of Master Your Finances with me, Kurt Baker, a certified financial planner professional. Sunday mornings at 9 a.m. on 1077thebronx.com. Good morning and welcome back to another edition of Master Your Finances, presented by Certified Wealth Management Investment. I am Kurt Baker, certified financial planner professional located in Princeton, New Jersey. I can be reached through our website, which is www.cwmi.us, or you can call me directly at 609-716-4700. Very happy to have with us this week Ari Fuchs of the DAC Group. He's a member of the firm's management committee as an integral part of the client service team, where he specializes in the analysis and execution of M&A transactions, as well as equity or debt capital raises, restructuring, and strategic corporate advisory services. Mr. Fuchs has more than 15 years of corporate finance experience and has advised both private and publicly held clients on more than 75 M&A financing and restructuring transactions, totaling in excess of $1.5 billion in aggregate value. He previously led buy and sell side M&A advisory mandates and public and private offerings, including IPOs, follow-on offerings, PIPEs, registered direct and private equity placements for middle market and small cap insurers. Prior to joining the DAC Group, he was with Duff and Phelps. Mr. Fuchs received a Bachelor's of Science from Yeshiva University Cy Sims School of Business, where he was on the Dean's Honor Roll list. He holds a Series 7, 63, and 79 FINRA Securities Industry designations, and has been named to New Jersey Biz 2018 40 Under 40 Awards Program, honoring professionals who have committed to business growth, professional excellence, and their community. He is also a recipient of the 2018 Emerging Leader Award by the M&A Advisor, an organization renowned globally for its recognition of leading M&A finance turnaround professionals. Mr. Fuchs is originally from Montreal and fluent in French. I will not talk to you in French because I'm going to get lost after you say anything. But thank you very much for coming on today. I actually met you at a chamber event where you kind of went through some of what you do, and I thought it was very interesting. And I think it's a very important part of what business owners need to understand, even if they're not thinking about, what we hear about M&A all the time, but we typically hear about it in the news about really, really large organizations. But it happens on all levels, right? And I want you to maybe talk a little bit about what your group does and what is an M&A, what is it? What's mergers and acquisitions? Maybe explain a little of the background of all of that for us, if you would.
Absolutely, Kurt. Well, first, let me thank you very much for the introduction. Very kind words. Hopefully they're all true. I think they are, at least. But again, thank you very much for the opportunity to share some words of wisdom with your listeners. Let me before I dive into it, let me just give a backdrop on the DAC Group and who we are and sort of what we do. The DAC Group is a middle market focused investment banking firm. We are based in Rochelle Park, New Jersey, and Bergen County, with offices in New York City and in the South Jersey, Philadelphia market. Our firm has been around for about 35 years. We were founded on the principle of providing high quality investment banking services akin to what you would receive at a Goldman Sachs or a JP Morgan, but to smaller businesses in the middle market.
Would you mind explaining what middle market is? I know we hear that term a lot. Would you mind, how do you define what middle market is? How would you define that?
And that's a good question, because every firm has sort of their own definition of middle market. Our sort of wheelhouse, so to speak, or sandbox, really revolves around businesses that are anywhere between 10 or 15 million in revenue up to 400 or 500 million in revenue. We've transacted with clients really across the gamut, but that tends to be really the sweet spot for us, at least. We're about 20 professionals across the firm. Very deep bench of expertise, senior heavy. Every sort of assignment gets really high level of attention from senior folks. From an industry perspective, we're really generalists. We've touched many industries over the course of 35 years, frankly, industries that some people didn't even know existed. Frankly, we didn't even know existed. And just incidentally, I mean, we did a transaction a number of years back for the the world's largest manufacturer of bolt tensioning devices for nuclear power plants. And who knew that was an industry?
I didn't. Interesting. Okay.
So again, I've been at it for I've been with the DAC Group for about 8 years, and principally provide M&A and restructuring services to my clients in a very sort of high touch atmosphere. So hopefully that gives your listeners a little bit of a backdrop in terms of who we are and what we do.
Okay. Yeah, that's great. No, definitely want to know the background. And then if you could kind of tell us a little about what, is mergers and acquisitions. Again, I think it's a term we all hear, but many of us don't really completely understand what that might mean. So if you would mind explaining that a little bit, what that is and how that affects us.
Absolutely. Absolutely. So mergers and acquisitions, I mean, we work with middle market business owners in helping them grow their business through acquisitions, which might mean acquiring a new product line, entering into a new geography through an acquisition. And at the same token, on the flip side, helping business owners generate liquidity from the sale of their business to strategic buyers, to financial buyers, and frankly, hybrid buyers as well.
Yeah, no, I hear a lot about that over the years. In fact, I've heard of it going both ways, right? Where people will try to expand the business and they might actually get a little too fragmented, and then they say, hey, maybe I want to sell off this particular division or this particular product line that maybe we're drifting a little bit from our core mission or what we really feel we're best at. So maybe to focus a little more on. So it kind of goes both ways, right? So you're trying to optimize your business and deciding, well, I want to either add more of this particular type of business, right? Or maybe things that we're doing, maybe that's something it's time for us to sell, whether in whole or in part, right? That's kind of how that all it's kind of interesting. You kind of optimize yourself, right? In a lot of respects, it sounds like.
Absolutely. I mean, our objective is to help our clients maximize the value of their business. Sometimes that is done through making acquisitions and enhancing their business profile or their opportunities for growth. At the same token, sometimes industries might be trading at at highs, and it may be time to explore an exit and perhaps take some chips off the table. And diversify your personal holdings. So, I mean, at the core of what we do is helping business owners maximize the value of their business.
So, can you kind of walk us through like a typical client and whether they come to you or do you approach them? I mean, when do they start thinking about these things? Does that grow internally, or is that something that they say, hey, by the way, maybe you should be doing something in your business you hadn't thought of? How does these things start to develop and actually mature into an actual transaction?
So it really runs the gamut.
Yeah.
Absolutely. I mean, it really runs the gamut. Ideally, clients come to us well in advance of a prospective sale. They may be looking at they may be looking at their business and may not have a second generation or a third generation who might be interested in taking the reins. And it becomes a question of what do they need to do today, 3, 4, 5, perhaps even 10 years in advance of the sale in order to position their business effectively for a sale down the road. And it's looking at and it's taking a really hard look at things like financial reporting and really diving into the weeds with our clients to help position their business when the time actually does come.
So a lot of this, and this is something that I've seen over the years when I've dealt with small business owners, is I know many of them are pretty good. I mean, you're dealing with kind of middle market, so they're probably pretty well documented. But I know smaller ones don't necessarily keep the records with the idea that someday they're going to sell it, or even if they try to finance it, they need to. I think a lot of us as business owners should pay a little more attention to that on an ongoing basis, because then when you are ready, even if it's you've done that documentation, especially if you need 3 to 5 to 10 years worth of information, right?
Yeah, I think one of the points that you just raised, I think, is synonymous with sort of the middle market business owner, which is business owners tend to spend time working in their business and not working on their business, and they understand what it means to make them successful and what it takes to sell a product or to sell a service to their customers. But when it comes time to actually working on your business and understanding sort of the key value drivers of a potential in a potential transaction situation, they're not necessarily always aware of it. And we worked with a business a number of years back Our client was in the road stripe paint manufacturing business. They manufactured paint intended for use in road stripe situations. And initially, they came to us and had a very successful business. They came to us and said, "Hey, we're ready to pull the trigger on a sale. I think the time is right. We're ready to move down to Florida." And we sat down, took a real hard look at their business, and thought initially, well, hey, you've done a number of things right. You're in a unique industry. Perhaps a buyer for your business might be a Sherwin-Williams or a Benjamin Moore that understands the paint segment that may not necessarily be in this specific paint channel, but really understands the paint marketplace. And fast forward downfield, we actually, over the course of our short engagement, we learned a whole heck of a lot about the business, to the point where we learned that each state has their own shade of yellow and white road stripe paint. That, for example, barriers to entry are incredibly high in that particular industry. For instance, the state of Pennsylvania will give you a mile of roadway, a mile of the Pennsylvania Turnpike to paint at your own expense. They'll monitor the wear and tear of your paint over the course of 5 years. And at that point, will qualify you as a vendor. So what ultimately sort of emerged from our analysis was that, well, hey, these guys are doing something incredible, but their unique access and their unique sort of formula, their barriers to entry, and the fact that they had relationships with most, if not every state DOT in the country, really separated themselves from the pack. And sort of fast forward to the end, who the ultimate buyer was. The ultimate buyer was actually not somebody from the paint segment. The ultimate buyer was a company called Lafarge, which at the time was the 6th largest manufacturer of concrete in the world. Now, why the heck would a manufacturer of concrete look to buy a manufacturer of road stripe paint? And the answer was pretty simple once you spend a little bit of time, is that they really wanted access to state DOTs. And the value driver for them was the relationships that this particular client had with state DOTs in the country. And they ended up paying 2.5 times the next highest bidder in that particular transaction. So it's being able to look at a business from a 30,000 foot perspective, understand what the key value drivers are, and then identify buyers to whom those value drivers are going to resonate. That's sort of what we do best, and that's frankly, how to achieve a premium value in an M&A scenario.
Wow, that's amazing, Ari. Appreciate you walking us through that. That was a great example. You're listening to Master Your Finances. We'll be right back. Welcome back. You're listening to Master Your Finances. I am Kurt Baker with Ari Fuchs of the DAC Group, and we're talking about mergers and acquisitions. And you gave us a great example of a company that really didn't. They're painting stripes, and they were doing it pretty much all over the country. And the ultimate buyer ended up being a concrete company who liked the fact that they could also potentially sell some concrete in those states. So they really like the fact they get access, and they end up paying a little bit of a premium. That kind of reminds me of real estate, right? Sometimes you get the right buyer for the right location. They might pay a little bit more just because it works really well for their particular business. In this case, what they were doing, and as far as their relationships went, had a very high value to the buyer. So I guess it's very important when you have kind of an outside person who knows all the different angles to look at it, might see something that the owner actually doesn't necessarily see because they've been busy literally out there doing their job and painting things, right? So I think that's great that you guys can kind of look at it from all different types of angles and really try to find out what the highest and best use really is of the business and who the buyer might be in that case. I know we've had a lot going on in the last few months. I don't know if you want to touch a little bit about how, since the beginning of the year, maybe that's affected your business or just mergers and acquisitions in general. I know we hear about some companies are doing really, really well, like Amazon can't keep up, and other companies like Brooks Brothers just filed for bankruptcy. So you've got all kinds of things, different spectrums going on out there. So what are you seeing as far as what's happening, and how do we find some opportunities in there?
Sure. I mean, I think, listen, it's no secret, Kurt, that M&A over the last several years has been incredibly active, probably some of the most active years, at least in my career. And it's been driven by just a lot of dry financial powder, a lot of cash sitting on the sidelines on the part of institutional investors, on the part of strategic acquirers and public companies looking to really grow through acquisition. And that's been one of the key driving factors of M&A over the last several years. The first quarter was it was no secret to that, with the exception of March. I think what we sort of, started to see as the pandemic took rise was a temporary pause in activity. I think strategic acquirers, public companies, private equity firms were spending a heck of a lot of time trying to assess their own individual portfolio companies and their own individual businesses for liquidity, for balance sheet strength, and to sort of assess what they needed to do in order to shore up their own individual finances. And what that really caused was a temporary pause in the marketplace as far as transactions are concerned. By and large, earlier stage transactions that weren't quite as far along, those at the moment are sort of on a temporary pause, I hope. Transactions that were a bit farther along, either at LOI stage or post LOI stage or due diligence, those transactions continue to move down the continuum, but albeit at a far slower pace than we were typically used to seeing. That said, I do think M&A has seen a pickup in activity over the last several weeks, likely really into the beginning of June, I would say. But the transactions that we're seeing in the marketplace are transactions that I would deem strategic. So there are opportunities where a particular target can have a transformative impact on the buyer and its profile. To take, for instance, again, this is going to be a large cap example, but Verizon Communications, which we're all certainly familiar with, they acquired a company earlier in the year. I believe that transaction was either in April or in May. They acquired a company called Blue Jeans. Blue Jeans is a technology company focused on video communication, and was an opportunity for Verizon to get deeper into unified communication, video collaboration, and seeing sort of what was going on in the marketplace with Zoom and other video call providers. They sort of saw this as an opportunity to become active and make a major splash in the space. So that was an acquisition that had transformative capability to Verizon and its business. Those are the types of transactions that we're seeing happen in the middle market as well. I don't think at the moment, we're seeing much, pure financial transactions. What I mean by that, pure play financial buyers such as private equity firms making platform acquisitions. Those have yet to sort of come back to the market. We do expect that to come back over the course of the next several weeks as sort of we understand what the reopening is going to look like, and the sort of situation in the debt markets calms down and stabilizes. I think that will come back. It's going to take a little bit of time.
I was just curious about, everybody had a disruption, of course, and I've been dealing with a number of people that did see minor disruptions, but they came back, and others are really in having a difficult time right now. They're not sure when they're going to come back or if they're going to come back. So when you have people at different stages of these acquisitions, I'm assuming they're re-looking at some of the financial information because we've had such volatility in the last few months for some companies. How do they respond to that? They go, well, wait a minute, we agreed on a certain price or maybe certain terms, but now I'm not quite sure those are going to work for us now based on the new, what's happening or what we think is going to happen. I'm just thinking about what about if you had a hotel as an example, right? It might have been doing really, really great in March, and now we're just not sure when the conventions are going to come back and when they're going to start booking up again, or maybe an airline. There's a lot of industries that were really, really strong at the beginning of the year, and now we're just not really sure when they're going to come back or what their valuations might really be.
I think that's an excellent point, Kurt, because I think, to your point, there are many industries that obviously were impacted heavily by the pandemic. I think there were other industries that, frankly, experienced incredibly positive surprises in terms of performance during the pandemic. Businesses that touched leisure, that touched hospitality, and that's not just the hotels, but those are the vendors that supply the hotels, vendors that supply airlines, the manufacturers of parts that go into aircraft. I mean, those are all businesses that unfortunately suffered meaningfully and materially during this period and continue to suffer. And I think those businesses are going to reassess their desire and their appetite for M&A, both on the buy side and the sell side. I think on the flip side, businesses in technology, businesses that touch manufacturing, businesses that touch food, all experienced incredibly positive momentum during this segment, during the pandemic. And, we expect those businesses to hopefully likely rise above the rest. I think at the end of the day, there is going to be, no matter what industry you're in, if you're contemplating M&A, there is going to be some sort of a penalty. And what does that mean effectively? So if you lost revenue, if you perhaps moved backwards in terms of growth, there's a clear penalty associated with that. Even businesses that perhaps did even better during COVID, their revenues are likely going to be adjusted for COVID, because COVID, we hope, is a one-time event. Buyers are going to attempt to normalize earnings in some way, shape, or form when they try and arrive at a valuation. Now, I think what we're going to see during this sort of interim period, there is going to be much more use of structured transactions. So typically transactions, at least over the course of the last several years, have largely been, purchase prices largely been made up of cash. I think now we're going to see a combination of cash, perhaps an earnout, perhaps seller financing, in order to manage the risk to a buyer, both upside risk and potential downside risk, or upside reward and downside risk, in order to sort of manage that on the part of a buyer. So we expect to see more structure in transactions going forward.
Yeah, you kind of went over that really well. Would you mind kind of explaining? I mean, I think we understand cash, but how do you use those the earnout, the seller financing? What are some ways that a buyer and a seller might use it to? Because of course, as you just pointed out, some businesses might be artificially depressed, and some businesses might be artificially inflated because of what's been going on the last few months. So somehow, I mean, a buyer and a seller want to come to an agreeable number that they think is fair on both sides. And of course, they might be further apart on that right now, because one's going to say, "Oh, well, we're going to stay at this higher number." The other was like, "Oh, no, you're going to go right back to where you're at before, 3 months ago." So can you explain a little bit how you use some of those tools to help the transaction connect together when these volatility is involved like this?
Sure. I think as looking at transactions like this and how buyers tend to use, and remember, we generally represent sellers, so our preference is to have as much cash up front. Given the dynamics in the marketplace today, we sort of expect buyers to come back to us with either seller financing or an earnout as a means to bridge sort of that valuation gap. And what that means is that, well, hey, if your business performed exceptionally well, or you think your business is going to perform exceptionally well in the second half of the year, or perhaps in 2021, as a buyer, we're prepared to pay you for that, but you need to show us that performance. And when you show us that performance, we'll pay you out for it in the form of an earnout. And the earnout and seller financing is really a means for a buyer to bridge the valuation gap between what the valuation of the business is perhaps today and where they think, or where a seller might think it might be in the future.
Yeah, I appreciate you explaining that. So you're getting still a considerable amount up front, but when you get to the nuances of that variation, you might say, okay, well, that's fine. If you could prove it out over the next 12 or 24 months, we'll maybe give you a little more, or maybe you'll take a little less if it doesn't work out that way. I appreciate that very much. You're listening to Master Your Finances, and we're going to be right back. Welcome back. You're listening to Master Your Finance. I'm Kurt Baker here with Ari Fuchs of DAC Group, and we've been talking about how you guys have been working through the pandemic and still analyzing companies and still looking at there are opportunities out there, and how we have to really take into consideration some industries are doing probably a little better than they might be doing a year from now, only because they've gotten a boost in business because of what's going on. Us working remotely and things like that, as well as some that have been depressed a little bit, like restaurants and hotels. So when you're dealing with the actual mergers and acquisition, you want more of a realistic long term. And you talked a little bit about how you could structure those, and you still like to see a decent amount of cash up front, but you can use things like the earn out and which is kind of deciding if you meet certain targets, you get extra money, or a little bit of seller financing to kind of stretch the valuation to where it's agreeable on both parties. So you're using a little bit more of that, which I think is good. So deals are still getting done. Some industries are doing well, others are a little depressed. But maybe we should talk a little bit about the fact that I'm sure you've been affected just physically as an office, how you do this. I know in my picture, we're doing a merger and acquisition. We're going to get the parties together. We're going to talk a little bit about what you do. You're going to meet with the owners and things like that. And so how do you do it differently? And maybe what are you doing that's similar to before the pandemic hit a few months ago?
Sure. I mean, social distancing has clearly had an impact, certainly on our business, but frankly, on business as a whole, particularly, service-oriented businesses. I think, we're a firm of 20 professionals. The vast majority of us are at the moment working from home. And we've sort of gotten used to it. I think clients, professional advisors have gotten used to it. And I think we've seen the increased use of technology play a tremendous part in helping transactions move down the timeline. Using things like virtual data rooms, which again have been in existence and in use, frankly, even absent social distancing. But the increased use of video, both for video calls as well as video tours. Buyers frequently, like to come in to kick the tires, certainly in situations when there's a manufacturing or production line. That type of due diligence at the moment is being done through video, both recorded and live. Obviously, meetings that are geared to moving transactions down the timeline, those are now being done through video. But I would be remiss to say, transactions are not closing exclusively on video. There will always have to be a human element of touch to get deals done. At the moment, we're sort of seeing those in-person meetings sort of move towards the tail end of a process. And it's a struggle as bankers because, frequently our management teams and the teams that we work with, they are the best advocates for their business and they sell their business the best. So we try as bankers, we try to ensure that buyers meet with our management teams as early as possible in the process in order to sort of start the sale process with a particular seller. But clearly the use of technology has continued to play a major role in getting deals done.
Yeah, you bring up an interesting point because I know, we really come down to being human beings, even though this is a very, financial transaction. And I've known people, just all types of transactions, whether it's real estate or a business or whatever the case may be, is when they connect people together, if they get a bad vibe or bad impression of them, they may be less likely to work with them because they may not trust them, right? A lot of this has to do with trust, especially when you're buying a business. And so I can see how a personal connection, at least meeting or talking to the leadership of an organization that you're thinking of buying or you're thinking of selling to, because you're going to go through a pretty in-depth conversation, or you're going to reveal a lot of information about yourself, your business, et cetera. And most people are not likely to do that unless they have a decent comfort with that other party, right? I don't want to get involved with you if I don't think you're acting in good faith and I don't think you're going to move with good faith, right? So, yeah, you mentioned that a little bit. So I'm kind of envisioning. I know a lot of people like to see or meet that person, right? So how have you worked through that, or you just?
Selling a business is probably, for most people, the single largest corporate finance decision they've ever had to make. Mm-hmm. And people like to do business with people they trust. And mm-hmm. Trust is something that takes time to develop, and frankly develops quicker when there's an in-person setting and an in-person call. And it doesn't happen once or twice, but it has to happen over several meetings, perhaps over weeks, in order to gain the trust. And again, likely a seller, was not completely walking out the door when they sell their business to a buyer. There is going to be an ongoing relationship there, and it's so critical that there's a meeting of the minds and there's an alignment of strategy. And again, some of that can certainly be accomplished remotely, but the vast majority of that really needs to be done in person. And I think both buyers and sellers now in this current market are making that extra effort to spend the time together, both virtually and in person. And I think those connections are happening, but it's taking longer for those connections to occur as a result of sort of where we are with social distancing.
No, I think that's a good point, but it can be done. I guess the bottom line is it can be done. It just might take a little longer. So if somebody's on the buy or the sell side, they'll have to just understand the process just may take a little bit longer than it might have a year or two ago. Is that kind of where you're at this point? Because it just takes a little longer to get all that together, is what it sounds like.
I think that's the right way of putting it, Kurt. I mean, it is taking a little bit longer, but it is certainly happening.
Okay, great. And I like the fact that because I remember when I think it was a real estate, like you weren't allowed to go see a house there for a period of time, and then all of a sudden because everybody's doing virtual tours, but at some point you need to see and kick the tires, so to speak, right? You want to go in the building and see what's going on. And so at what point do people typically go out and do that physical visit? Maybe you're doing the video, but there's only so much you can see with video, right? I mean, people still want to go there and see what's going on. So how does that typically work these days?
Historically, visits occurred early in the process.
Okay.
It occurred once you sort of narrow down the buyer field to the most likely candidates. At that point, we would sort of invite those buyers in to meet with management, kick the tires, and frankly, do it really all at once. And you really started that face-to-face interaction much earlier in the process.
Mm-hmm.
I think there is a lot that we can do today in order to sort of kickstart that. And again, we talked a little bit about sort of using video tours and certainly video calls to sort of kickstart that. But we encourage, to the extent buyers are comfortable, and certainly maintaining with the proper social distancing. But we encourage those face-to-face meetings to occur, not just between the buyers and the sellers, but frankly with the sellers management team. Because you're not buying an individual, you're buying an entity, you're buying people, and there has to be a meeting of the minds of that culture. And we're certainly emphasizing that outreach earlier. And it's really a case by case situation where sort of people, if they feel comfortable getting in a car, getting on a plane, to make those meetings happen. And again, to the extent that those transactions are incredibly strategic, we're seeing those meetings happen earlier and earlier. But at the very least, those meetings are absolutely happening, towards at the very least towards the tail end.
Oh, that's great. No, I'm glad to hear that, because I mean, it is critical that we do get together at some point, because again, we're human. We want to see what the entity is doing, and the management team, as you point out, is key. And that's one of the things they say when you're a small business owner, is you want to make sure that you set up your organization so in theory you could step out and it'll still run, right? So that's where the management team comes into play, where you have the expertise is within the company to keep running it, even if the founder is not necessarily active in the day-to-day. It's more of an option for them, and they kind of step back and do more of an advisory capability at that point. So that's really kind of part of getting it ready. And then when they meet the team, right, then the buyer needs to know what they're getting as far as the actual entity goes, because businesses ultimately come down to people, right? And that's kind of what you're getting. So I think that's an important process.
Absolutely, Kurt. And I think, again, to your point, it speaks to what we mentioned earlier in terms of pre-transaction planning. It's understanding who the key individuals are within your business, ensuring that they remain incentivized, ensuring that they're part of the management structure of the organization, because we all know, again, that whether it's a second generation or whether it's a second layer of management, those individuals are critical when it comes time to a sale. And it's important to identify who those individuals are and maintain high quality relationships with them.
Yeah, you bring up a valid point, and I guess when an owner leaves, so to speak, and you have senior management, I'm assuming you want some continuity as a buyer. So that's probably part of that conversation about how those roles might integrate into a larger entity, or whether they're going to be run standalone, or whether they're going to come under another umbrella. I mean, isn't there some concerns when somebody's being acquired, as far as those people that are going to be part of the acquired entity? And how do you typically try to address those with people?
So I think, when we approach a particular client, I mean, I think we try, and our objective is to provide our clients with optionality. Some clients come to us and, we sold a business several years ago. Our client said to us, Ari, I'm a really good entrepreneur. I'm a really good visionary, but frankly, I'm going to be a terrible employee. So find me a buyer that's going to take me out whole. I want 100% cash, just get me out. And we said, hey, Frank, just make sure, just let us do our work. Let us sort of give you the options, and then, have a sense and, take a look what those options look like, and then, make your determination at that point. And sort of fast forward to the end, and we brought Frank a whole slew of options, some of which involved entirely cash out, some of which were with financial sponsors that were going to partner with him and bring incremental resources that he could not have brought on his own. And the ultimate transaction basically was one in which he continued to hold a sizable minority stake in his business, because he saw the resources that these buyers were going to bring to bear for his business, and frankly saw an incredible opportunity for that second bite at the apple. So he took a chunk out up front in cash, and then that equity stake was frankly likely at this point worth as much, if not more, as the original cash purchase. So
that's amazing.
Our objective is to provide optionality, and if a buyer wants to exit stage right at the beginning, we can create a situation for that. If a buyer has confidence in his business but really just wants to take some chips off the table and reduce his risk, we can engineer a situation for that as well.
No, I think it's fantastic. You brought up another great example of when, again, somebody kind of looks at your business from the outside and sees things that you don't necessarily see because you're so close to it. In this case, somebody was ready. They just want to step out the door and take their money and go. But now they got excited again, like, wow, I really like what you brought, and I actually want to stay involved with the new entity at some level. So it's a win-win, right? So he got his money, and he got to still do probably what he enjoyed very much, which is amazing. You're listening to Master Your Finances. We're going to be right back. Welcome back. You're listening to Master Your Finances. I'm Kurt Baker, here with Ari Fuchs of DAC Group, and we've been talking about the current state of mergers and acquisitions with a little interesting twist this year with the pandemic. Things have been a little bit different, but transactions are still getting done. You're using a little more technology. Might take a little bit longer to develop those relationships, but they do get done. And we're just pointing out several options that you're showing owners that they didn't necessarily realize that they had. Like just before the break, we had an owner that just wanted his cash and wanted to leave, but through a full analysis and finding the right partner, that the owner just decided to take a minority stake, took a decent amount of cash up front, still got the best of both worlds, so to speak, and moved on. Wasn't even something he probably even thought about until you brought him the options, which I think is fantastic. And that's really, I think, a big part of this is, as we said earlier in the show, is a lot of owners are very good at their business and how it operates and how to serve their clients and do a really good job there. They don't necessarily know the highest value their business may have to a buyer and the best way to exit. But part of that is really pre-planning, as you said. But we also want to preserve, what we have and make sure that we manage through volatile situations like we have now. So you want to give us some ideas about the best way to kind of manage through a period that we're dealing with right now and maximize the value of your company?
Sure, Kurt. I mean, I think success or failure during this time frame, during this pandemic, is going to depend on a business owner's willingness to adapt to sort of what the new reality is. And, we've sort of taken a look at this and identified several, key, tangible, actionable steps that business owners can sort of look at and initiate in order to preserve and enhance the long-term value of their business. So what are some of those examples? So I think number one at the very top of the list is going to be what we call sort of liquidity management. And what does that mean? That means cash is the lifeblood of any business, and ensuring that the availability of cash throughout these uncertain times is incredibly, incredibly critical. What does that mean? I mean, number one, it means identifying sort of the core segments of your business that generate cash and make sure you direct sufficient resources to strengthen that segment of the business. It means focusing on cost reduction where applicable. It focuses on, again, reducing and minimizing non-essential variable expenses. To the extent, and I hate to, even go in this direction, but to the extent that, businesses require a reduction in workforce in order to maintain and preserve cash, those decisions need to be made quickly and as deep as possible at the beginning, because that's going to reduce existing workforce anxiety regarding further cuts. But what's critical is sort of that, cash is king, and managing liquidity is critical in this environment. And along that same vein, the ability to sort of forecast and stress test your financials for all potential scenarios. So, whether that means a reduction in customer demand, what might that mean? What does it mean if, access to your supply chain is impaired and your inability to get product to your customers? What is that going to mean to you and to your cash position? Those are critical things that at the front end of this, we've recommended and continue to recommend clients to look at. Certainly, we talked about key individuals and business continuity planning, assessing and understanding who your key employees are, making sure that they're motivated and they're incented to produce, identifying and assessing and protecting your supply chain, protecting your ability to collect cash from customers, and managing very tightly your accounts payable and receivable, which are both inflows and outflows of cash. And some of the more traditional tangible items, again, communication is critical. Transparent, regular communication is so important. Employees have such a thirst in this uncertain market for knowledge. They want to understand and sort of hear what's going on at the top. And even when the responses are, you may not have full vision and guidance, but I think people have a thirst for that communication. That is also incredibly important. And I think, listen, at the end of the day, this period, to the extent that you preserve your cash position and enhance your cash position, there are going to be opportunities for you as a business owner to capitalize on, whether that's making acquisitions of potentially distressed competitors, maybe it's accessing a new geography, or maybe it's buying a new product line. If you properly manage your liquidity and your cash, you're going to have opportunities that others will not have access to. And, we're constantly coaching and advising our clients to look at things like that in order to, again, preserve and enhance the value of their business.
Yeah, you just brought up a whole lot of great points. But you're right. I think we always talk about a cash quota is king, right? And especially in times where you have some unknowns in there. And I know that most small business owners, at least the ones I know, are very, very much connected to their employees, but also you have to really pay attention to the spreadsheet, right? You really have to, in my opinion, and maybe you can correct me here, but I think you have to set some kind of goal target, right? You have to say, look, if we decline a certain number, we've got to lay off one or two people, whatever the case is. You've got to put it down in a plan and then just follow the plan, because the problem, I think sometimes small business owners have, well, I really like my employees, and they'll just draw their cash down because they're trying to hold on to everybody, when in reality, the business model is just not being supported, and they should be making cuts. And I think another thing you brought up, I think it was good, is the supply chain. I remember hearing about like the grocery stores and how the restaurants stopped buying, and then we couldn't get meat because the way they package it, I guess, was for restaurants, and we couldn't get milk. And so I guess communicating with your supply chain to find out what their capabilities are, and making adjustments on that end too, and keeping all those lines open, and being proactive, I guess, about all of these different aspects of the business, right? Is that kind of, am I saying that right? You are, Kurt, you're right on the money over here. I mean, I think, one of the key things, and again, I think it's so important, certainly for your audience, I believe, that they take a long and hard look at their business. And I think there has to be a combination sort of emotion, but it also has to be rooted in, you call it the spreadsheet, call it the financial, call it performance. And it's incredibly common to see business owners in what we sort of call the 51st state. Now, Kurt, do you know what the 51st state is? Well, I think Peru wants to be it, so maybe not.
Well, the 51st state, Kurt, is the state of denial. And business owners,
okay.
It is incredibly common to see business owners sort of push things off and think things are going to get better quicker, and inevitably, by pushing off the difficult decisions, you end up putting at risk the value that you've worked so hard to create. And it's the ability to sort of see through that and make educated assessments. And again, you may not be able to necessarily do it on your own. You may need to look to,
Right.
Your professional advisors to help you with that. But it's making those key critical decisions early in the process that will preserve long-term value in your business.
Yeah, I think you brought up a good point. Is having a third party look at it, whether it's your financial advisor, your CPA, whoever the case may be, have somebody just look at it from a number saying, hey, look, you can only endure this for 30 days, whatever then you're going to have to do this. Then you're going to have to do this. So you set up these targets that you can give yourself. Well, then let's make sure we don't hit those downward spirals, right? Let's keep above that number somehow. But if we can't, you're going to hit reality, right? And I've seen the same thing myself. And that's why I get very concerned. They go, well, it'll get better. And before you know it, 6 or 12 months later, they're broke and they were doing fine. And they're trying to do, what they can, but the business simply isn't where it needed to be, where if they'd made the cuts early on, as you pointed out, they may actually be in a really good position to bring all their people back at some point, or maybe even, buy another business because they were the ones that held out and really held on to the core business, and they made the necessary cuts and adjustments quickly. And that's the thing I think that I see a lot of us don't do as small business owners is we have a hard time self-analyzing and saying, oh, we got to really do this right now because everything is working out fine for such a long period of time, but you have to do it. And it's great to bring in a third party. They'll look at it objectively and they'll see it really clearly because to a third party, these things are always very clear, in my opinion.
Yeah. Yeah. I mean, I think Kurt, you hit the nail on the head with the early portion of your comment. I think the once you've sort of made that call to your key financial advisors, whether it's your financial advisor, whether it's your CPA, whether it's a firm like ours as your investment banker, that is half the battle. Being able to bring that sort of independent vision to your business and give you an accurate assessment. Again, it may not be what you want to hear, but being able to be on the receiving end of an independent assessment of your business is going to help you in the long run. And certainly in our view, we've certainly been the beneficiary of a lot of work from business owners that have been sort of in this state of limbo, where we've sort of, helped them make critical decisions to, again, preserve the value of their business.
No, I think it's amazing what you're doing. And I agree, being an advisor as you are, there's a huge value to it. And as you point on many levels, pointing out things they should be doing, things they shouldn't be doing, strategies that maybe they hadn't thought of, because they're so busy working, as you point out, in their business and not on their business. So any last thoughts? You've done an amazing job before we go.
Yeah, I mean, I think, listen, my view is that, entrepreneurs are going to survive. They are going to prosper. The market for M&A will come back. The value is going to come back. We've been in this, in these situations in the past, and we have made full recoveries. My sense here is that our recovery and sort of the return to normal is going to be far quicker than I think folks expect. I was talking yesterday to a former CEO of a vaccine company, and he affirmed that the marketplace will come up with a vaccine, and a year from now, people will be saying COVID what? People aren't going to remember what COVID is. So I think things are going to come back to normal, and I think it's critical sort of during this interim period that you business owners take the appropriate steps to preserve and maximize the value, whether that's through an independent assessment, through liquidity management, perhaps it's through a transaction. And I think we're all well positioned to advise our clients.
Well, that's excellent advice. And Ari, I appreciate you coming on. Ari Fuchs of the DAC Group. You've been listening to Master Your Finances. You can subscribe to the podcast by going to masteryourfinances.us. And remember, together we can master your finances so you can enjoy financial peace of mind.
Okay. Nice.
Thank you, Ari. That was excellent.